Welcome to RBC's Markets in Motion podcast, recorded December 5th, 2025. I'm Lori Calvasina, Head of U.S. Equity Strategy at RBC Capital Markets. Please listen to the end of this podcast for important disclaimers. The big things you need to know. First, several things that U.S. equity markets have been linked to. Breadth, Bitcoin, private market fears, Fed cut expectations, and consumer sentiment have gotten better in recent updates. Second, a few signals from our year-ahead outlook analysis have shifted a little over the past week. And third, there have been a few interesting twists and turns in positioning since Thanksgiving week in terms of sectors and factors. If you'd like to hear more, here's another 5 minutes. Let's start with takeaway number 1. Several things that stocks have been linked to have gotten a bit better. After experiencing a 5.1% drawdown, the S&P has rallied back strongly starting the Thursday before Thanksgiving. So what exactly has the stock market been thankful for? To answer this question, let's review the list of tactical challenges we highlighted right before Thanksgiving. On the positive side, the breadth of the U.S. equity market has improved. Bitcoin has stabilized, and fears around private markets have faded. This issue rarely came up in last week's client meetings, and we've also seen better price action in the public companies related to private markets. Additionally, expectations for the Fed to cut in December have firmed up. And on Friday, the stock market also got good news from the University of Michigan Consumer Sentiment Report, where headline sentiment moved up and came in ahead of forecasts due to improving expectations. These are all things which have been positively correlated with S&P performance in recent months and years, or have been indicators that have provided useful tactical signals about near-term price action. For some of the other tactical indicators we flagged before Thanksgiving, recent trends constitute less of a tailwind for stocks, but do appear to be headed in the right direction. For example, the rate of upward EPS estimate revisions for the S&P 500, its top 10 names, a proxy for Mag 7, and the rest of the index have moved up. But they failed to recapture their summer highs, and so we think it's still fair to say that earnings sentiment, while still quite strong, may have peaked. Valuations are another example. Next 12-month PEs for the S&P 500, the top 10 market cap names, and the rest of the index, along with the NASDAQ 100, have only shown very modest improvement of late. It's possible these charts will look much better once new earnings data cycles in. We're also keeping a close eye on retail flows to passively managed U.S. equity funds, which are still deteriorating. This potential sign of fatigue among retail investors stands in contrast to commentary we heard from investors over the past week, expressing confidence the retail investor has not yet slowed down. Moving on to takeaway number 2, a few signals have shifted slightly since we published our year-ahead outlook. Right after we got back from Thanksgiving, we walked through the 5 models that feed into our 7750 12-month forward S&P 500 price target, as well as our thoughts on the growth value and small-large trades going forward. Since we've published that price target, there have been a few shifts in the signals from the analysis that feeds into those calls, which are modest in nature but still interesting. On the S&P 500 outlook, one of the primary new developments is that net bulls in the AAII survey have rebounded sharply, taking the 4-week average back to a range that's been followed by an average 12-month forward return in the S&P 500 of 10.8%, a slightly weaker signal than the prior update, which feeds into our price target. Previously, net bulls were at a level typically followed by a 12-month forward return in the S&P 500 of 15%. By contrast, the signal from our GDP model strengthened slightly, with consensus real 4Q26 GDP estimates moving up to 2% year over year. With this move, the signal from this model is on the cusp of a more favorable range for 12-month forward S&P 500 returns. The current signal is for a 5.7% move in the S&P 500. The average 12-month return when quarterly real GDP on a year-over-year basis is in the 1.1 to 2% real GDP range. The signal would become 10.3% if the 4Q year-over-year real GDP forecast moved in the 2.1 to 3% range. What we're seeing in these data sets syncs up with what we heard in U.S. client meetings last week. While there were some exceptions, most, particularly hedge funds, skewed more bullish on the economy than the consensus economic forecast. Cyclical excitement in these conversations was driven by excitement over impacts from stimulus, both the 2025 tax bill, particularly tax refunds for consumers, and anticipation of additional stimulus measures in 2026 ahead of the midterms. Overall, the tone in our meetings with U.S. equity investors last week leaned bullish, and most of the investors we spoke with seemed eager to put short-term worries aside and focus on the longer-term trajectory. On small caps, the main development last week was that ISM manufacturing came in weak yet again. We've been feeling better about small caps due to improved valuations and earnings revision trends, but our enthusiasm remains restrained by our sense that it's still not clear to us that a truly hot economy is on the horizon. Small caps are widely understood to be more sensitive to the domestic economic cycle than large caps, and the ISM manufacturing gauge is one of the cyclical indicators we watch closely for our small cap call. Typically, small cap outperformance is accompanied by an upswing in ISM manufacturing, a condition that is simply not in place at the moment. The tick up in consensus GDP forecast last week is admittedly a step in the right direction for small caps, but a tiny one. The consumer sentiment improvement is actually more encouraging. And we'll wrap up with takeaway number 3, interesting twists and turns on positioning. To start with, earnings quality is flip-flopping again. On our factor work, high earnings quality is starting to underperform again, reversing a brief period of renewed leadership that had been calming the nerves of many of our small cap PM clients and contributing to our own increased comfort level with small caps. This has occurred alongside an improvement in passive flows back into small caps and quantum names perking up again. Next, a few sectors are trading places. Within the S&P 500, renewed outperformance by the tech sector has come alongside a fade in leadership from healthcare. Healthcare does still look reasonable on our valuation work, and earnings and revisions flows to the sector do remain strong. We continue to count healthcare among our more interesting market weight sectors right now, but it may simply be that it's being treated as a defensive alternative to tech. And finally, earnings revisions have been re-energized in energy. In last week's client meetings, investors seemed particularly interested in our thoughts that energy, like healthcare, has been a cheap sector in the S&P 500 with positive funds flows, and that we'd seen some improvement in earnings revisions for the sector prior to Thanksgiving. We cautioned our clients that we'd need to wait and see if the improvement in earnings revisions for energy would stick. Our latest update indicates that S&P Energy does indeed remain in slight positive revision territory on the rate of upward revisions. That's all for now. Thanks for listening, and be sure to reach out to your RBC representative with any questions.
This content is based on information available at the time it was recorded and is for informational purposes only. It is not an offer to buy or sell or a solicitation, and no recommendations are implied. It is outside the scope of this communication to consider whether it is suitable for you and your financial objectives.